To start, I think I'd like to take a look at the economic outlook and compare our thoughts to what the market is currently operating on. The bulls are telling you to expect a rapid economic growth spurt in the first half of next year due to vaccines. And every time you get a vaccine announcement, positive one, you tend to get a little downdraft in gold, plus some added stimulus, but most commentators will say no inflation. Interesting enough, the inflation break-evens in the bond market are telling you that inflation expectations are on the rise, but that's another matter. We'll get to that later. In our view, serious damage has been done to corporate balance sheets. You're now beginning to see a second wave of cost cutbacks and reductions in capital expenditure plans. The labor market, which is critical to everything, is very weak and getting weaker. Consumers are at the breaking point, and therefore massive fiscal stimulus will be required in 2021, much of it financed by the Fed's quantitative easing. So looking at the labor market specifically, initial jobless claims are still running at about 4 times pre-COVID levels. This is extremely disappointing, very bad news. The latest ISM data, but the green fizzles out and it is now falling rapidly. Again, disappointing. And if you look at the chart on the right, just to note that 14 million workers face unemployment benefits loss at the end of this month, and the employment in small businesses, which came back to about half, they recovered about half of what was lost, is now trending downward again. So again, not good news on the labor front. And it looks like all the money that was spent last year, the huge deficits that were incurred, were not enough, and we're going to have to do it again. And just a few little highlights to indicate this. The U.S. Census Bureau predicts that 17.8 million adults are currently behind in rent or mortgage payments, and of those, 5.8 million will be evicted January 1, evicted or foreclosed on. That's a kind of frightening number. And if you look at Moody's, their estimation is that unpaid rents total about $70 billion currently, which is putting a huge squeeze on small landlords. And then conversely, in the third quarter, nearly 25% of household income came from government transfer payments. So that tells you why the recession, which is really very deep, has not been all that visible, because it's been papered over by the Fed and the Treasury. But if you really want to know the truth, 75% of Americans don't have $500 to meet an emergency. So what's going to happen? We're going to see a lot more stimulus, and it's going to be funded by the Fed. So if you look at the numbers, the deficit in 2020, which ended in October, was forecast to be 3.1 trillion, and it was 3.1 trillion. Federal expenditures were actually double tax revenues, which is pretty amazing. We're expecting to see another US $3 trillion deficit this year, and that will take the year-end at year-end the debt to about 30 trillion. And it's interesting to note that in 2020, the addition to the Fed's balance sheet was equal to the increase in the US debt. So it's obvious that the Fed is monetizing the US deficit. They may claim to be otherwise, but throughout the universe, in fact, that we know of, that's what's going on. Central banks are printing money for fiscal expenditure. And that's what makes it very different from the quantitative easing of 2008 to 2014, where the money stayed in the financial system. This stuff is not. So we think the Fed will have to do at least $3 trillion in QE this year to fund the deficit. Their current pace is just $1 trillion a year, about 80 billion a month. And I have to flood the market with new net issuance, and that will put pressure upward on interest rates. At the same time, we have markets that the Fed can't afford to see rates go up, certainly not anymore. And most people who've compared COVID-19 to the Second World War, they might have a point in terms of fiscal and monetary management. So if you look at this chart on the page now, The blue line looks at the inflation-adjusted 10-year Treasury rate. It's been plunging as gold. The red line has been rising. Then you see at the end, the blue line pops up and the red line pops down. And that tells you all you need to know about the gold price and where it's going. And it also tells you why the Fed will not want that blue line to continue, because, as we've said, there are just too many companies and an economy itself that cannot stand for higher rates. Low rates are built into the US economy now, and it cannot be changed except during a terrible crisis, which we hope not to see. So moving on to the next slide, we're therefore expecting gold-friendly Fed policy in 2021, consisting of increased quantitative easing and fiscal stimulus, which will further weaken the US dollar. We note that it has broken its 52-week low in the last couple of weeks and is looking rather pathetic, even though there's an all-time record short position in the US dollar, which should have caused a bounce by now, but it's not there. And we'll see yield control, which will lower real yields, which is the biggest boost you can give to gold. And in fact, we think the big trade next year is going to be low yields, driving investors out of bonds and into gold. If you look at the numbers, they're really quite amazing. 80%, this is courtesy of Ray Dalio, 80% of global debt in local currency yields less than 1% before you take into account inflation. So obviously all negative yielding. And US corporate bond yields are now, for the first time ever, negative after you take into account current inflation expectations. So overall, we therefore think that the gold bull market has just begun. The global supply of gold grows at about 1.3% a year. How about 28% for US dollars currently, year over year? Global above ground gold is less than half of 1% of total global money supply, also expressed in US dollars. And gold's share of global assets is less than 3%. It's been much higher, and we think it is going much higher. And you see that chart on the right.